If you are at all concerned with what's going on in the economy, this is the video for you. Cause who else shoots Nerf gun rockets? I think I just like the sound of it. But before I get started with this practical breakdown on the economy, let's get a little bit of a message from some depressed YouTuber that's going to tell us some sad stories while at the same time trying to sell us gold and fear. And remember, oh, I spilled.
By keeping interest rates artificially low, they have created a bubble that's much bigger than the one that popped in 2008 because we have no real savings in this country. We have enormous debt. Everybody is levered up to the max, government, the private sector, business, consumers. Because rates have been so low, we've borrowed so much money. The market wants interest rates to be higher. But the Fed doesn't want to allow that to happen because the road back to normal interest rates is a very bumpy one because it's going to take us right through another financial crisis.
That's right, because after all, if we all listened to Peter Schiff, we would come to the same conclusion that
we need to go through this recession, and higher interest rates are part of the cleansing process, as painful as that process is now going to be.
Because apparently putting people through a recession and taking away growth opportunities from poor communities in our society who are just now starting to experience some growth is the right thing to do.
But the Federal Reserve has no stomach for doing what's right.
Especially if you're selling gold.
Hot take there.
Well, now that we have that out of the way, let's get into today's content and the outline. Number one, what just happened, and was it what we expected, or was it not what we expected, and why does it matter? Number two, what the Federal Reserve says is wrong with our economy, and we finally got some comments from them on household debt and business debt and some possible cracks in the economy. We'll also talk about what this means for our investments now and, yes, our Wealthfront savings accounts. Then we'll jump in to try to figure out how bad a recession would be if we actually had a recession. We'll also talk about negative interest rates, the yield curve, and whether or not the Fed is lying to us. Because after all, the Meet Kevin Report is all about news that makes you money. So number one, there was no surprise the Federal Reserve dropped rates. So this is what I said in the video that I said I would delete within 24 hours, which has been deleted. We said the most likely scenario was that the Federal Reserve would drop interest rates by 0.25%. Well, while this happened, the Fed also gave us enough of a wink wink, nudge nudge to sort of imply the possibility of some additional rate cuts coming down the road. In fact, Chairman Powell himself voted against the quarter-point rate reduction. Why? Because he wanted it to be a half-point rate reduction, which was sort of our more dire worst-case scenario. So what we actually got was a signal from the Fed that was a mix between the scenario of everything's dropping 0.25% and the potential of a half-point drop. And so what did stocks do in response? Well, rather than going up, like I said in scenario 3 with a half-point drop, or down, like I said they would with a quarter-point drop, the market stayed flat because we got both signals. Mortgage rates also appeared to stay relatively flat. A really interesting mix between these two scenarios. Just so you know, usually the Fed says, we're dropping rates 0.25% and that's it. We're just gonna wait and see what happens and that's all we're gonna do. Well, this time, because of them nudges and them winks, we got some implications here that actually left reporters saying things like, hey, you're sort of like modestly implying that we might see some future reductions here. However, along with this information, we also got some pretty dang incredible insights into what the Federal Reserve believes about our current marketplace. And these are really crucial impacts that are going to matter no matter what you're investing in, particularly real estate, stocks, bonds. But let's focus on that right after this message. Remember that in about 3 weeks, I will be in Miami hosting an in-person real estate crash course, and we are doing our private live stream for our online courses this Saturday and Tuesday coming up. So make sure you join using coupon code 10XTheFed to get 22% off before September 30th. Remember, you get access to all of the online recorded lectures, the future lectures that get released, our Discord community, and our private live streams. Now, number 2, let's talk about debts and the economy and some more things we learned without spilling the coffee this time. Now, just so you know, I watched and dissected the entire 52-minute press conference that the Federal Reserve held, and consistently, the Fed pointed towards 2 things as problems in the economy, and otherwise, they didn't find major issues that we needed to be worried about, which this is all going to play into, do we think the Fed is lying to us? Are they trying to keep us complacent so that we keep spending money? But the only 2 things the Fed kept talking about were
not just the geopolitical events, but also from slowing global growth and trade policy uncertainty. So,
AKA stuff going on in the UK and stuff going on between Trump and China. Now, the Fed did also say that, yes, obviously manufacturing is having some difficulties, but this could be part of a normal evolution in an economy that's leaning more towards services now, which is about 70 to 75% of the United States economy. When asked about the possibility that the Fed is creating a bubble with easy money, they responded and said, hey, you know what? Household debt is solid. If anything, it's at lower levels than it historically has been at.
if you actually look at households, households are in very strong shape. They're less levered. They've got less debt. They've got more income relative to their interest requirements. And that they're in very good shape.
And yes, while business debt is larger than historical norms, we are 11 years into an expansion, and it is normal to see greater amounts of debt with larger businesses, because as the economy grows, the size of businesses grows, which also means that debt grows. However, they are paying attention to some particularly highly leveraged companies to make sure there aren't issues that are going to pop out of those.
The level of debt relative to GDP in the business sector is at a high level. However, so is the size of the business sector. So actually the business sector itself is not materially higher leverage than it was. Nonetheless, there are a lot of highly levered companies. And that's the kind of thing that happens during a long cycle when there aren't downturns. For now into our 11th year, you do get that kind of phenomenon in a long cycle.
Now, you may or may not have heard of that sector before, but basically it's called the commercial leveraged loans sector. So in case you see that, they're talking about business debt, and oftentimes it's businesses with low credit ratings, kind of like subprime housing in 2008, except now businesses. When asked about inflation, the Fed came out and said, hey, you know what? We have no expectations of inflation exceeding 2% through 2021.
As you can see from our policy statement from the SEP, we see a favorable economic outlook with continued moderate growth, a strong labor market, and inflation near our 2% objective. And by the way, that view is consistent with those of many other forecasters.
In addition to that, they also do not see the unemployment rate going above 4% through 2021.
We expect the job market to remain strong. The median of participants' projections for the unemployment rate remains below 4% over the next several years.
In fact, the Federal Reserve seemed relatively peachy about the United States economy, which was a little bit of a shock to me, and this is sort of what creates that impression that, are they just lying to us, and are things worse than they really are? Which we're going to talk about in just a second, but what's another popular thing that people keep talking about? The yield curve. Well, the Fed actually had a response for us about the yield curve. In fact, Chairman Powell had a very fascinating response, in my opinion at least, and he said,
we monitor the yield curve, but why are long-term rates low? There can be a signal about expectations about growth there for sure, but there can also just be low-term premiums. For example, it can just be that there's this large quantity of negative yielding and very low yielding sovereign debt around the world, and inevitably that's exerting downward pressure on U.S. sovereign rates without really necessarily having an independent signal.
Basically, because so many other countries have really low rates, more people are buying the United States Treasury bonds, which drives up the price, supply and demand, more people buy it, the price goes up, but drives down the long-term yield. And that actually might be the reason to blame for this yield curve. That is, the yield curve maybe isn't necessarily an indicator now anymore of the economy falling apart, but maybe instead it's an indicator of everybody else's economies having problems, which is true, them having lower yields, which is true, and then more people buying United States Treasury bonds, which not only feel safer, but yield more money. Now, what does all of this mean for our investments and our Wealthfront savings account? Well, let's just go ahead and start with Wealthfront here and say, yes, this means the high yield savings rates are probably going to come down again. This means we might see a Wealthfront yield of 2.07% and a Betterment yield reduction of another 0.25% downwards for the high yield savings account. But let me also be fully transparent with you and show you that my Wealthfront savings account has $20 in it. I really don't care because I don't like to just give you generic, middle of the road BS information. I like to give you information that matters and information that I believe in. And that's why I have currently today $100,401 in my Wealthfront investment account, which, because I've referred enough people, I spend $0 in fees on beyond the Vanguard fees, because they basically put all my money into different Vanguard funds, which is cool because they take care of all that crap for me automatically, and all I just keep doing is transferring money over to Wealthfront until I go buy a real estate deal, and then I take money out of Wealthfront, and then I go buy real estate, because what am I a big fan of? Constantly buying wedge deals. Because see, when I put my money into this Wealthfront account and they go buy Vanguard funds, I pay market value for those Vanguard funds. If I can buy below market value real estate, why would I not do that all day long? Oh wait, that's right, I do. And I just wanted to bring that up before I get another million DMs on Instagram from people going, oh my God, Wealthfront reduced the rate again, here we go, they're a scam. No, this is expected. Now, it technically hasn't happened yet, but we all know we're probably going to get an email tomorrow about this. Now, in the video that I said I would delete, I also suggested different investment strategies, and I'm actually feeling, based on what the Federal Reserve said, a little bit more bullish than I was feeling before I went in. Now, I didn't like that Jerome Powell was thinking we needed a half-point cut, but he specifically said that he feels the United States is going to grow at a solid pace of at least 2% over the next year. Now again, this could all be smoke and mirrors, but that does make me feel a little bit better that it's kind of like the United States is on this island and there's a tropical storm going around at sea, aka Europe and overseas. And the United States overall isn't doing too shabby. Now, don't take this the wrong way. I'm not jumping up and down to do flips anytime soon. And I'm not just trying to say that I think things are good, so you buy the real estate investing course. Honestly, I think the real estate investing course will be a great purchase, whether the market is great, good, bad, or in shambles. Because no matter what, we're all gonna work together to figure out how to make the most money at any given time. But I think now it would also be useful to talk about what would happen if there were a recession. How bad would it be? And today we're going to refer to the international edition of the Financial Times. That, by the way, is a picture of the drone that may have attacked the Saudi oil fields. So just in case anybody was thinking they're little like DJI phantoms that fly around your backyard that attacked the oil rigs. No, they're bigger. Okay, these are bigger than the ones that we buy. But anyway, the article I wanted to refer to was published on the September 18th, 2019 edition, entitled Global Economy Takes a Hit at a Bad Time. And the article says that global manufacturing is in the doldrums and the US-China trade conflict is unresolved, with obviously the issues of Brexit lingering. We hear the same thing over and over and over again. But what's interesting is they specifically talk about a surge in the price of oil, which even though the Saudis are suggesting they're going to be back at full production by the end of the month, oil is still up a bit. And they're saying we need to watch because oil prices will have a big impact in the global economy at kind of a bad time. So if oil stays up, it could be dangerous for the marketplaces, so keep an eye on this. But anyway, they say when a price surge is caused by a shock to supply, it acts as an effective tax on consumers of oil. Then he goes on to say, for countries that are hovering on the brink of recession already, this could make the difference between stagnation or a mild contraction. And then, of course, he points to Germany and Italy. Now, that's big. The last thing we want is stagnation or stagflation, which could come after that. So oil prices up, bad. Keep an eye on oil if you're worried about the economy. Oil, oil, oil. This stuff matters. But it's interesting that as long as oil remains tempered, he believes we would only see a mild recession. And in case you're wondering who he is, it says an economist at Berenberg. You can go read the article yourself. But then we have another one from a CNBC interview with Tom Fink, chairman and CEO of investment management firm Barings. And he suggests that any recession that happens in the United States would likely be shallow given the current state of the country's economy. From the US point of view and the US economy, if we're talking about a recession in the US, the consumer and growth industries like tech have offset declines in other industries. We still have tight labor markets and we still have growth. I mean, look, these are just two dudes, you know, who knows, but it's fascinating. It's interesting to see that the people that aren't trying to sell us gold, or sometimes Bitcoin, are still kind of struggling to figure out what is it beyond a global economic slowdown, a European slowdown, Brexit, and the China trade war? Why does it seem like the United States is still doing decently well, which is similar to what the Federal Reserve is telling us? Well, then we can get to the argument of, is the Federal Reserve lying to us? And I think the most important thing to do here is not to try to speculate about whether or not they actually are, but rather, what are the two scenarios? And for this, we go to the whiteboard. So we have two options. Either the Federal Reserve is lying to us to keep us complacent and keep us spending money to keep the economy going, or the Federal Reserve is not lying to us and things really aren't that bad. Well, let's get the easy one out of the way. If things are not that bad, what should you do? You should go buy wedge deals in real estate, possibly flip. I would stay away from the short-term debt. That's still risky for me. I think that's probably going to be risky in any kind of marketplace. And honestly, I'd still be buying the index funds in the meantime. Now, if the Federal Reserve is lying to us,
and I think we'll learn quite a lot in the next 6 weeks. I think generally forecasts show growth similar to our own forecasts coming at about 2%, which is a good solid year.
I would still buy wedge deals, but in my negotiations on red deals, I would use bad news days, aka red days, to negotiate my deals harder and better, which, by the way, I teach you how to negotiate in the in-person events or the online course. I would definitely not flip. I would not do any kind of short-term stuff, which I wouldn't do in that scenario anyway. And honestly, if I thought the Fed was lying to me, I probably wouldn't buy market value index funds. And at this point, I'd probably put my money into savings and be looking at wedge deals in real estate, because remember, wedge deals in real estate, they insulate you, they protect you from the downs of the marketplace. So if you think the Fed's lying, go for wedge deals in real estate and savings. If you don't think the Fed is lying and you think things are decent, then I'd probably go wedge deals, maybe the flips, and the index funds, I'd turn those back on. And there you have it. Now make sure to follow me on Instagram. You could see a picture of myself and Jordan Belfort, yes, the Wolf of Wall Street, and we're in the Wolf's Den for the Wolf's podcast. It was awesome. Cannot wait for that video to drop, and then maybe we could even do a video critiquing myself. We'll see how it goes. Thanks so much for watching, and until next time.